All right, the release of today's Fed decision is about an hour away. Our next guest says there's very little the Fed can actually do to spur economic activity. Well, Stanley is chief economist at Pierpont Securities. He's a Bloomberg best economic forecaster, and he's joining us now live from Stamford, Connecticut with more. And Stephen, I got to ask you, I mean, liquidity does not seem to be the problem with the U.S. economy, right? There's plenty of money out there. It may not be, it may be sitting on bank balance sheets as capital, but, other than the Fed backing up truck to individual homes and releasing a lot of money on individuals, what else can they do at this point?
Right. Well, that is a bit of a problem for the Fed. I think they've filled the economy to the gills with liquidity, and, you can lead the horse to water, but you can't make them drink. And I think what we're dealing with here is a crisis of confidence, not a lack of money. So, throwing more money at the problem isn't necessarily going to do a lot of good. That said, obviously there is a lot the Fed can do, or hopefully there's at least something the Fed can do that would bolster confidence right now, which has been a bit shaky over the last week or so.
And I know, Stephen, you're of the opinion that Ben Bernanke, as a Federal Reserve Chairman, is an interventionist, sort of by nature, which suggests that he has to do something. He's not going to just leave this alone. So what do you think is the likely outcome out of today's meeting?
Right. Well, I think the easiest thing for them to do is to use the language in the statement as a way of bolstering confidence. Certainly, they're going to acknowledge that the economy's been softer than expected and that they're disappointed in that. I think they can also very easily and with little cost promise to stand by and be ready to move if necessary. Those things don't really cost them anything. And I think, they can certainly strengthen the extended period commitment. There's been a lot of talk about perhaps bringing the size of the balance sheet under that umbrella. Up until now, extended period has really only referred to the level of the funds rate. So, these little things at the margin aren't really going to mean a lot in terms of substantive monetary easing. But they might help to bolster confidence a little bit.
Hey, Stephen, let me jump in. Adam Johnson here down on the New York Stock Exchange. Given the changes that we've heard from S&P, they lower Fannie, they lower Freddie, among other things, some of the munis. Do you think we'll get any kind of comment from the Fed about S&P?
Oh, I don't think so. I think they're going to want to stay away from that, and certainly more broadly, I think they'd like to stay as far as possible from all the political storm and drang that's going on, and I would throw the credit rating issue kind of in there in that bucket.
And let me ask you, Stephen, you brought up the point of a crisis in confidence. We saw such a dramatic reaction after the president's speech yesterday, when really, in terms of our fiscal situation, we were in no different a situation yesterday at sort of 1:30 or 2 p.m. than we were a week ago. How does Ben Bernanke, what are his options to respond to that? Do you think his rhetoric will change slightly? Will we hear something new in his tone?
Well, I don't think they're going to really dive into that. I mean, I think, the statement has traditionally kept to the Fed's meat and potatoes. They'll talk about growth, they'll talk about employment, and they'll talk about inflation. Certainly growth and employment have been disappointing, and more so lately with the, even though the last Friday's number was not so bad, the employment numbers haven't been great over the last 3 months. And of course, the GDP revisions, I think, were a big downside surprise. So, I think that's what they'll focus on, and just at least make sure that people understand that they're on the job and that they're watching things, and that it's not like they're just sitting there and impotent. I think it's important also for the chairman and the committee to emphasize that they do have options. As you mentioned, I'm a bit dubious about the efficacy of some of those options, but the Fed can't go around telling people they don't have any bullets left. That wouldn't bode well for confidence. So I think they'll underscore that there are things they can do. At the same time, I'm not sure they're really going to be willing to step forward and do any of the big, options that have been discussed out there today. If things continue to be rocky, he has the Jackson Hole speech later this month and another Fed meeting in 6 weeks.
And then lay out for us, tell me this, between bond traders, equity traders, what do you think is a likely response? Currency traders to what the Fed has to say. A lot of traders are going to be going word by word through this statement. Give me sort of a best case scenario and a worst case scenario.
Well, I think, market participants may have gotten their hopes a bit high at this point. There's been a lot of discussion about the Fed doing things with the balance sheet, whether it be, full-blown QE3. That's not really a consensus view, but, other things that they could do. People have talked about kind of an Operation Twist type thing where they buy more paper in the long end and, there are various things that have been talked about, and I think none of that is likely to come to fruition today. So, maybe a little bit of disappointment in the equity market, which over the last week or two, the few times that it has rallied, it's often been on the back of hopes that the Fed was going to come in and rescue things. And perhaps the long end of the Treasury market could be disappointed as well if there's nothing on that front.
Hey, Stephen, only 20, 30 seconds here, but if the Fed were to do some sort of QE3 buying, when might that announcement come? How many weeks or months away?
Well, I mean, obviously, if we get into a crisis situation, it could come very quickly, as we saw in 2008. But in the normal course of events, I think they'd want to prep us for that. So, September certainly at the earliest, but perhaps even November.
All right, Stephen, we have to leave it there.